Hello once again. I'm indeed grateful for those who had turned up for my last webinar on Zoom on the 4th of December. I spoke about ETF investing and the response was overwhelming. I'm happy to have answered all the good questions asked by my attendees. Today, I would like to give my viewers a treat to thank you for your support by supporting my past webinars and this YouTube channel. In today's video, I will share with you snippets from my webinar on the 5-step framework I use to screen a winning ETF. For those of you who want to learn about the basics of what ETFs are, you could click on the above link to watch part 1 of my ETF series. Hello everyone, welcome back to STA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high-quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, what does my 5-point framework consist of? And how do I do my due diligence to screen for my desired ETF? Here is the overview of the 5-point framework. They are investment objectives, the ETF structure, implication on taxes, evaluating performance, and evaluating liquidity. In this video, I will walk you through the purpose of each individual step and how to apply them. The first is investment objectives. In this step, you will have to start with identifying your own investment objectives first. For example, what is your investment horizon, long-term or short-term? What sectors do you favor? Or do you just want to invest in an index as a whole? Then you screen for an ETF that suits your own investment objectives. Most ETFs have a main theme of what their investment objectives are. Index ETFs are designed to track indices, so understanding the index that the chosen ETF tracks is important. ETFs come in many flavors, and an ETF's performance follows an index or sector closely, like the STI or the Straits Times Index or S&P 500. Also, different indices select their holdings using different rules. Since indices can differ significantly in terms of investment type and strategy, understanding the index construction methodology is key in helping investors differentiate among many indices in the marketplace. You can find out the objectives of each ETF by visiting this website, www.poems.com.sg/ETF screener, to screen for your desired ETF. I will put the website link in the video description section below. Using the Poems ETF screener, you can search by the various ETF categories, and when you click into an ETF that you like, you will see that its main page will already show the ETF's objectives, as you can see from this slide here. Once you have already selected an ETF, you can then go to its portfolio to identify the top 10 holdings the fund currently invests in. The portfolio composition is also depicted in a pie chart for easy visualization. There are many other things you can screen for using this ETF screener database, such as the fund's expenses ratio and many more. So, do spend time to explore this website, and you can definitely get a lot of value out of it. The next step is identifying the ETF structure. There are different ways of structuring an index ETF to achieve the investment objective of a fund. The two most common structures for an index ETF are physical replication and synthetic replication. So, what's the difference? Physical replication gains exposure to the performance of an underlying index by holding all, also called full replication, or a portion, typically known as optimized or stratified replication of the underlying assets. While synthetic replication, on the other hand, gains exposure to the performance of an underlying index through swap arrangements. So, why should I care about an ETF structure? As part of the ETF selection process, it is important to understand the differences in ETF structures, whether it is physical or synthetic, as replication mechanisms can impact cost, performance, and risk profiles. Physical replication tend to be more transparent and are easier to understand, but can limit access to certain markets and exposures, while synthetic replication enables access to markets and exposures that physical replication may not. The downside of synthetic replication is that investors may be exposed to counterparty risk. The website I introduced earlier will also show the various ETF structures, which I have shared here. The third step is implication on taxes. Taxation of ETF investments may arise at three levels: the investment level, ETF level, and treaty level. At the investment level, shareholders may be subject to taxation on income and capital gains. Investor taxation depends on the investor's personal circumstances in their home jurisdiction. Withholding tax mainly arises in the country where the underlying equity or fixed income investments are domiciled. The tax rate partly depends on the treaty between the country where the underlying securities are domiciled and the country in which the ETF is domiciled. There can be a withholding tax at 2 out of 3 levels of the taxation described above. When the ETF receives income or gains from the underlying investments, there can be local withholding taxes in the jurisdiction in which the underlying investment is situated. Next is the ETF level. When the ETF makes a distribution to the investor, there can be a withholding tax in the ETF's country of domicile. Finally, at the treaty level, investors who qualify for the 15% US withholding tax with onshore taxpaying investors in many European and Asian countries who have provided the W8 band documentation. At the non-treaty level, investors will be paying the full 30% US withholding tax rate, including offshore and onshore investors not providing W8 band. To find out more about taxes, it would be better to speak to a tax professional at your base country of residence. The fourth step is to evaluate performance. Performance doesn't just mean how much money you make or lose as the ETF underlying index rises or falls. It is also about how closely the ETF matches the index performance. Most index ETFs are managed to track the investment results of an index. ETFs that fail to closely track their respective indices often reflect the difficulties of investing in the market, such as the unavailability of certain securities or regulatory restrictions, including some that may be expensive or impossible to buy or sell. ETFs that do not fully replicate an index securities hold a subset of securities designed to closely track the index. A well-managed ETF minimizes both tracking error and tracking difference to deliver accurate index performance. Tracking difference is the return difference between the ETF and its underlying index over a given period. It addresses how well the fund tracks the index returns, while tracking error is the volatility of the tracking difference. It reflects how consistent the tracking quality is. Investors tend to benefit from a lower tracking error because it means the tracking difference is more predictable. Tracking error can be caused by a wide range of factors, such as the difference between the holdings in the fund and those in the index rebalancing and transaction costs, and the different tax treatments of an underlying income in the fund and those in the index fund replication method. And finally, at step 5 of my ETF due diligence framework is to evaluate liquidity. ETFs are easily tradable, even in times of market stress. Their exchange tradability improves liquidity, enabling investors to buy or sell ETF shares or units with ease. Therefore, the liquidity of an ETF is not limited to its on-screen liquidity, which is indicated through the ETF's bid-ask prices and average daily trading volume. Instead, we can think of an ETF liquidity as an iceberg, with multiple layers of liquidity below the surface that are not always visible at first glance. A lot of trading occurs in the secondary market and is no different than a stock. Investors buy and sell ETFs in the market using common order types, and ETFs are quoted with bid-ask prices. However, the secondary market's liquidity is only the tip of the iceberg. For example, if there are not enough ETF shares in the secondary market, which typically may be referred to as ETF inventory, participants can access the underlying market liquidity by purchasing the underlying securities and exchanging this for ETF shares in a process known as creation. These units can then be sold again in the secondary market. Overall, ETF liquidity is driven by multiple different components, with a large majority deriving from the liquidity of the ETF's underlying securities. Liquidity can greatly impact cost and performance of an ETF if you are not careful. Therefore, as a rule of thumb, always select ETFs with an established ETF provider that manages a large portfolio and sizable assets under management. So with this, I highly encourage you to start investing now by using the 5-step ETF selection framework that I have taught you today. I hope the community here has learned and gained something today from today's video. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section below, and our team can provide a personal touch and talk to you about your investment plans. See you in my next video. Goodbye.